Hello, I'm Chris Sarley, Investment Research Analyst at Fund Calibre, and today I'm delighted to be joined by Ian Rees, one of the managers on the elite-rated Premier Multi-Asset Growth and Income and Multi-Asset Monthly Income Funds. Ian, thanks for joining us today.
No problem. Glad to be here.
Given the name of the funds, income is the obvious place to start, given the pressures we've been seeing on company dividends in the UK and across the globe. What have you been doing to sort of tackle these challenges? And particularly when you've got a monthly income fund, that's obviously got some additional challenges. Maybe just talk us through how you're seeing things and what you're doing.
Yes, certainly. Well, when it comes to looking at the income, there's a few considerations there just to think about, and as in where the income's coming from and what the drivers behind that. And certainly, as you point out, we have seen a big reduction in UK dividends from the UK market, somewhere in the region of 47%. But I think there are four drivers behind that. Really, there's a regulatory pressure that's going on, and that's being seen in the likes of banks, where they've been requested not to pay dividends. You've also seen political pressure, where companies are accessing some of the government help schemes, and therefore they felt it a social conscience aspect to not pay dividends. You've then had companies through necessity that just can't pay dividends, and obviously airlines and travel companies are probably good examples of that. And then finally, you've got companies which are probably being quite cautious and have reined back on their dividend profile. So when we look at UK dividends as a starting point, yes, we see a big reduction, but we think that not all of it is actually a permanent loss of dividend. And we think that actually, as some of the issues start to abate, as some of the regulatory pressures and political concerns start to ease, then dividends can come back fairly strongly within the UK market. Now, we found it quite interesting looking at how that dynamic has been playing out. That we've been quite conscious not to actually chase income, because when you're chasing income, you can end up in the scenario that you're actually selling holdings because of an income cut when they're priced at a pretty low level, just to sacrifice any potential upside for replacing that with additional income. And that's something we've been very conscious not to do. What has helped us in our funds has been the ability to be quite nimble early on in the crisis. Now, towards the end of February, we noticed quite a big disconnect between what the bond markets and equity markets were valuing in. And that to us was a signal to raise even more concern in our overall asset allocation. So that then enabled us to actually take our cash position in the monthly income fund up to 20%. Which is a very aggressive and bold move, and one that we haven't done for more than 11 years, in all honesty. But that cash position was then able to be deployed back into the markets come mid to end of March, as valuations had come down to a level where we felt more inclined to put money to work again. And obviously, as valuations had come down, yields had gone up as well in that respect. So by virtue of taking on that sort of action, we found that our income account was largely untouched, even though we took quite a hit, or there is going to be a hit, on our equity income generation within the funds.
You mentioned that 20% cash holding. Has there been much turnover of the underlying holdings in the portfolio, or has it been a case of deploying that cash in recent months? Or maybe just talk us through where you've seen the opportunities on the back of the sell-off.
Well, largely it's a case of deploying it into areas we are already familiar with and can see the opportunity quite readily. Obviously, being a multi-asset fund, we're quite diverse in nature anyway, which means we not only own equities and bonds, we own other asset classes where we find good ideas. Now, during March, we revisited a lot of the bond funds and credit funds where we'd taken money out of towards the end of February, and we were buying them at much lower prices and much higher yields. So it was mostly a case of revisiting areas we were familiar with. We have done one or two changes in the portfolio. We had an absolute return fund that we bought at the start of the year because of our concern in overall market valuations, and we wanted a diversifier. It actually held up pretty well in March, and that gave us the encouragement to actually sell that holding again and use those proceeds to reinvest in some really good income ideas. So that was a good asset change within the portfolio, but mostly it's a case of revisiting familiar holdings and making sure that we topped up sufficiently to take advantage of the opportunities we were seeing.
Over a quarter of the monthly income fund is held in specialist bonds. Maybe tell the viewers what types of opportunities you're finding in that space, and what sorts of areas do specialist bonds fit into?
Yeah, we classify pretty much anything that's a non-mainstream sovereign or corporate credit as a specialist bond. So it's probably got a very niche sector focus, or it's got quite a niche aspect on how it's structuring the debt profile for that exposure. So we find a lot of opportunity here, particularly as a better alternative to high yield bonds. Now, high yield bonds are probably familiar with most people these days as being a corporate credit which offers a decent yield. For us, we get concerned with the lack of spread opportunity, or i.e. the valuation of those assets looks a bit too rich. They've also suffered from the effect of having quite low covenants in recent years, or actually having no covenants at all. And whilst that may mean that initially default rates in the high yield sector remain suppressed, it does mean that recoveries are going to be much, much weaker looking forward as the cycle progresses. So that's a real area of concern for us. Instead, we like to look for bonds which have some real asset backing. And to us, that gives us an extra layer of protection in those types of credits. Now, one really good example of a fund that we took advantage of in March was Semper. Now, this is a US credit boutique who invests in mortgage-backed securities. Now, these mortgages are very good quality mortgages, and you've got real property backing behind them. So low loan-to-value ratios supporting the strength of those bonds. In addition, you've also got the structuring protection of where you are within that capital structure of that security. And again, we had an additional level of protection with that. Now, these bonds had really fallen really through technical levels only. Some forced selling, some leveraged holders were being forced to liquidate positions. And so this particular instrument had gone down quite a lot, by almost 15%. And we felt that this was a really good opportunity because the underlying fundamentals remained robust. And the pricing we were seeing was going to suggest that it had to be a multiple of the maximum default rate we've seen in these type of instruments, looking back on the history, of 2%. It had to be almost 8% or more. So huge level of protection there. We felt that there was really good recovery potential in the capital price, and we were getting very strong yields as well. So that was an example of a fund which we then took up to our maximum limit of 5% to take advantage of these opportunities.
And just lastly, beyond bonds, are there any other asset classes or sectors that are providing strong income opportunities? Perhaps maybe you're not seeing them now, but perhaps you're eyeing them up in the future. Just maybe talk us through a bit about that as well.
Yes, there have been a few areas which we've been investing in recent years, and a couple that have held up phenomenally well, actually, over the crisis. A couple of areas such as property. Now, we know that commercial property has been in people's crosshairs given the concern about what's happening with retail and obviously some of the office property demand that's out there. But we've been focused much more on alternative property, where there's a really good level of income which we think is sustainable. So we own a couple of care home funds, and yes, they've been at the forefront of the current crisis. They're on the front line there, but they are seen as an essential service, and they've been particularly robust throughout, and they've had no disruption to their dividends that they paid, which is good to hear. We also, and another good example in the property space would be Supermarket Income REIT, which is a specialist vehicle owning supermarkets, which have obviously been trading very well of late. And these are some of the larger supermarkets where they are quite dominant in their local areas. So we feel quite comfortable that that's a really good investment. Complementing that, we've found some really good property debt funds out there, where you're actually loaning and have effectively a bond exposure to a property company. So you have real asset backing through the property company. And we've got funds there in the like of Starwood, which is a listed closed-end fund. And again, we've not seen any reduction at all in its dividends throughout the crisis. Those sorts of positions are yielding anywhere between 5.25% to 6.5%. So really good contribution to our overall income accounts.
Ian, thank you very much for spending time with us today.
Thank you, Chris. Keep well.
And for more information on the Premier Multi-Asset Growth and Income and Multi-Asset Monthly Income Funds, please visit fundcalibre.com.